Very good morning, everyone. Audio video clear to you all? Can you please confirm? Audible and visible? All right. Very good morning. I hope you all are doing good. So, we are back again in this series of RBI Annual Report analysis with lecture 3 of part 1, which is our prospects and review of the economy, right? So, it is lecture 3, part 1. All right. In the last class, we had discussed till this point, okay, employment. So, we were discussing about the domestic economy, the prospects of domestic economy, right? And in domestic economy, we have covered till employment. From today, I'll be taking up from this section, which is climate action. So, what has been the India editorial की class आपकी होती है 12 बजे, okay? So, in climate action, what is the performance of India, which is also very, very satisfactory and very incentivizing, okay? So, let's see how has India performed in case of climate action. As you all know that sustainable development is also a very integral part of your syllabus, phase 1, phase 2, right? So, this is important. You can write these examples in your answers. Climate action, if we see, so climate change performance index is there. This is an important index, right, which you should remember, climate change performance index. In this climate change performance index, I'll be telling you about in detail of this index. So, India's rank has improved to 4th best performing nation among 63 countries. This is indeed a great achievement for India, right? Although you might be wondering, if you have read that India has got 7th rank, I'll tell you why is it written 4th here in the report, because initial 3 positions are vacant. No country has performed well to be 1st, 2nd or 3rd rank holder. That's why automatically, despite having 7th rank, India holds the 4th best position in this index, which is very good performance, right? So, this is a milestone achievement for India. Climate change performance index, okay? So, rank, you should remember that India has improved to 4th best performing nation among 63 countries, all right? Now, what are the indicators on which we have performed well? What were the indicators? So, the indicators were reduction in emission intensity. You should remember these things on which parameters India has performed well, right? So, first is your reduction in emission intensity of GDP. All right. What is emission intensity? Emission intensity is basically your emission of carbon dioxide per unit of GDP. Okay. So, if an extra unit is contributed to GDP, how much carbon dioxide is emitted, right? So, this is known as your emission intensity of GDP, emission of CO2 per unit of GDP. Is that clear? Right? So, in this we have performed well, which shows that we are moving ahead towards, sustainable development and green GDP. More and more we are producing, we are able to reduce the per unit carbon dioxide emission. Is that clear? Okay, so this is good achievement. Then increase in non-fossil fuel energy capacity. Increase in non-fossil fuel energy capacity. So, this is again important. We are continuously expanding our scope in non-fossil fuel based energy resources like solar power, wind energy, right, nuclear, all these things, okay. So, this is something important which has India performed well upon, right. So, these were your parameters on basis of which we have got this 4th rank among 63 countries, right. Now, what have been the initiatives taken by Government of India which has resulted in all these kind of achievements? What are the initiatives? These initiatives are very important since they are mentioned directly in your report, right. So, among all other schemes which are there ongoing of the central government of India or of the state governments, the schemes which have been mentioned in the report are very, very important, okay. So, initiatives. First is notified carbon credit trading scheme. Notified carbon credit trading scheme. Do you know what is a carbon credit and how do we trade carbon credits? Yes or no? There's something called as carbon market, okay, in which carbon credits are traded, okay, selling and buying. Anyone knows what is carbon credit? You must have heard about carbon market or carbon credit. So let me explain to you what is carbon credit first, then you will be able to understand why is this scheme important, what is this carbon credit trading scheme of Government of India, right? So carbon credit is basically, carbon credit is your permit. It is a particular permit which allows you to emit a particular ton of carbon dioxide, which allows you emission of certain limit of carbon dioxide, which is generally in tons. Are you getting my point, right? So these are basically permits that, okay, if you have this carbon credit, you have this much permit of emitting your carbon dioxide, right? So why do we have carbon permits? These have been, new innovative tools so that industries can gain out of it, because you trade carbon permits, and also while producing the output they can reduce their carbon emissions. Are you getting my point? So for example, how is this traded? For example, let's consider that there is an industry A and industry B. Okay, these both are certain factories, right? Industry A and industry B. Okay, factories. Now suppose this industry A has a carbon credit, okay, carbon credit. This also has a carbon credit. Now suppose both carbon credits have allowed them emission of say 1 ton of carbon dioxide, or say not 1, say 2 tons, okay, 2 tons. So this has allowed, this carbon credit which this industry holds, say allows 2 ton of carbon emission, and this allows only 1 ton. Now what happens is, in the entire production process, if industry A has been able to produce by emitting only just say 1 ton of carbon, 1 ton of carbon dioxide or carbon, then how much is this industry left with? Another 1 ton, isn't it? Yes or no? Are you following this? Right? So 1 ton is left. Now this much capacity permission is still left with this industry. So what this industry can do is, this industry can either produce that much again, or either can sell this much permit to say this industry. So now industry B has 2 tons of carbon permit, 2 tons of carbon credit. Have you got this? So this is how carbon permits are traded. So this has earned, this industry A has earned by selling this permit to industry B, and this is how they have limited their emissions as well. Isn't it a good initiative, right? So this is how carbon markets work and carbon permits are traded. Now we were discussing with regard to the policy of Government of India. So Government of India has started carbon credit trading scheme. What is the aim of starting this scheme? Government of India wants to have our own domestic carbon market. Okay, we want to have our own domestic carbon market where we issue the carbon permits. Okay, so that our industries have say practical emission limits, as well as we are able to grow, or we are able to grow at a greener path. Okay, so this is the aim of this industry, of this scheme, carbon market. So it will be an entire industry in India, or to say a market. Market means a mechanism where these carbon permits will be traded, bought and sold. Who issues these carbon permits? There are various agencies who have been authorized to issue. For example, the agency is authorized by your UNFCCC, right? In case of India, the organizations related to your energy conservation, like Energy Efficiency Bureau, all these organizations can issue carbon permits, right? So there are a lot of agencies related to this issuances of carbon permits. All those are there at the international and at the domestic level. So this is important, carbon credit scheme. Then we have launched National Green Hydrogen Mission. Okay, This is another very important national green hydrogen mission. Now, when these concepts are there in these schemes, you should remember what is the meaning of these concepts, right? What is green hydrogen? If we have launched the national green hydrogen mission apart from this, so this is another important scheme. What is this national green hydrogen mission? National green hydrogen mission is basically promoting green hydrogen. Now, what is green hydrogen? This is important. Green hydrogen, anyone knows? Yes, anyone would want to tell me what is green hydrogen? Is there anyone? So what happened is, since you know that hydrogen is a more cleaner fuel, right, as compared to the other fossil fuels, more Am I audible to you, to all of you? Am I audible? Yes, but not visible, right? Or is this visible as well? Okay. Okay. All right. So we were discussing about green hydrogen. Okay. All right. Good. Green hydrogen. What has been the difference between brown hydrogen and green hydrogen? So why are we shifting to more cleaner means of producing hydrogen? Is that the earlier one which you had as brown hydrogen, it was produced using coal as the source of energy, but now in green hydrogen you use renewable sources of energy to do the electrolysis process, isn't it? Are you getting this point? So in green hydrogen, the source of energy produced to do the process which is known as electrolysis, in which your hydrogen and oxygen gets separated, right? So that energy is also renewable. This is why it is called as green hydrogen. So this is important mission launched by Government of India. I have told you the difference between brown and green hydrogen, right? So this is the difference. Now there are many types of these terms right over there which you should refer to, which you should find out the concepts. Okay. Now, is this clear? Carbon credit scheme and green hydrogen mission. So this is the thing, climate change performance index, on which India has performed well or very well, right? So we need to understand what is this climate change performance index is. Okay. So when we talk about this index, climate change performance index, it is basically published jointly by 2-3 organizations. So it is published jointly or produced jointly by German Watch, the New Climate Institute, and Climate Action Network International. So it is jointly published by your German Watch, the New Climate Institute, and the Climate Action Network International. Okay, you are talking about grey hydrogen. I would appreciate if you tell me what is the difference between brown hydrogen and grey hydrogen. Okay, there are several terms associated with, like blue, brown, okay, green. So you should be very clear about these terms and you should try finding out the differences. Okay, otherwise I'll discuss with you. First, let me complete this. Climate change performance. What are the basis on which the index tries to rank the countries? So it basically evaluates the countries across 4 key categories or 4 indicators. What are these indicators? First is your greenhouse gas emission. First one is your GHG emission, which is your greenhouse gas emission, right? What are greenhouse gases? You all know. Greenhouse gases are those gases which are responsible for raising the temperature, average temperature of the earth. Isn't it? Right? Okay. So, first indicator is your greenhouse gas emission. This has been provided a weight of 40%. Okay, 40%. Then you have renewable energy, which is your 20%. Renewable energy sources you all know, right? For example, your solar, wind, etc. Solar power, wind power, which can be renewed, which do not get exhausted with certain limit of use, right? So these are your renewable resources of energy. Then 20% of weight is given. Then energy use. What is energy use? How much energy is being consumed by your economy in different sectors. Okay, so energy use, total energy use is provided with a weight of 20%. And then climate policy. What is your climate policy? How much sustainable development oriented is your climate policy? How much your climate policy adheres to the international conventions, say by UN or by UNFCCC? Okay, so all these things are you're taken as your indicators, and then countries are ranked. So it shows that India has performed very well in all these 4 indicators, isn't it? Right? Now, the thing which you should note here is that no country performed well enough in all these indexes to achieve an overall high rating. That's why the first 3 positions remain empty in this index, which is the recent index if we talk about 2023, okay, 24. So the initial 3 positions are left empty. Why have they been left empty? Because no country was able to perform very well on all these 4 categories. Okay, GHG emission, energy use, renewable sources of energy, and climate policy. That's why. And that's how India, although got 7th position, okay, so India secured the 7th position in 2024, CCPI 2024. Due to absence of countries in the first 3 spots, it automatically becomes 4th. Okay, because 3 are absent, so when you count from 4, it becomes your 4th position, right? This is why we say that India is 4th best performing country in your climate change performance index. Clear? Although the rank is 7th, you should remember this position. Directly it can be asked. But if questions, how is the question framed? That's how you will find out the answer. Okay. So if it is directly asking and the option is 7th and no 4th option is there, then 7th will be the right answer. And if they have asked that since 3 positions are left empty, then what is the rank of India? Then the answer should be 4th best performing country. All right. So then, is this clear to you all? Climate change performance initiative, these schemes, right? And why India has held 4th position overall. Now let me proceed further. If we talk about the inflationary pressures, if we talk about inflation in India, what has been the trend of domestic inflation? Let's discuss. So in 2023-24, reflecting the combined impact of calibrated monetary tightening, easing of input cost, and supply management measures, these are certain points related to your inflation related performance in domestic economy. Okay, so first of all, before moving ahead with each of the point, the report says that these performances in case of India and in terms of inflation has been a result of some combined factors. What are those combined factors? First, monetary tightening. So do you remember in the previous classes we have discussed a trend that at the global level, central banks have been indulging in monetary tightening to absorb the liquidity, because at the global level as well, the inflation is well above the desirable limits. Isn't it? Are you able to recall? Right? Okay. So this is the thing. Due to monetary tightening, this has impacted the Indian economy as well. Easing of input cost pressures, and since we have also discussed post-pandemic, post-COVID, supply chains were disrupted, but since now supply chains have improved, and we have particularly discussed that Indian government is trying to manage the supply chain, otherwise inflation will rise to higher levels, right? So Indian government has been taking initiatives which we have discussed in the earlier classes to maintain the supply, demand and supply balance, right? So to maintain the supply availability of certain products. So due to good availability of say inputs and all, good supply chain and reduced supply disruptions, the easing of input cost can be seen here, which is to say that the cost of inputs have eased. So when there is lesser cost of production, cost of inputs is what? Cost of production, right? So when you have lesser cost of production, you will be able to produce your goods and sell those goods at a lesser price in the market, and that's how you will be more competitive, isn't it? And then when you produce, when you sell in the market at lower prices, the inflation also gets eased. Is this clear? Okay, so this is the thing. And supply management measures, since I have discussed with you that government of India is continuously trying to measure, to maintain the supply level of all the major goods, whether they are used as inputs or final goods or etc. Clear? Right? So now let's talk about each point. If we talk about the headline inflation first. Okay, headline inflation. Now you all know what is the difference between core and headline inflation, right? So headline inflation is, which includes what? Quickly, tell me. Headline inflation includes what? Headline inflation includes what? It includes your food and fuel products. Okay, so it includes your food and fuel products. It has softened to 5.4% from earlier 6.7. Okay, so this is important. You should remember that in India, the headline inflation has eased. This is important. Headline inflation has eased. Why? If you remember that although food prices are rising in India, but if you remember in the last class only we have discussed that fuel prices are easing as compared to the earlier times, because now you have good supply of fuel sources, energy sources, right? So due to easing of fuel supply, this can be seen. Although food inflation is higher in India, right? If you remember the last class, we have discussed this. So it has fell to 5.4% from 6.7%. What is the reason? Driven by fall in core inflation. Okay, so particularly the report says that the fall is particularly in your core inflation. So removing food and fuel, as I told you, food inflation is rising. So, but fuel inflation has eased to some extent, but more contribution in falling of headline inflation in India is due to falling down of core inflation or reduction in your core inflation, which means when you exclude your food and fuel. Okay, so core inflation has reduced. This is the thing. Core inflation again reduced to 4.3% from 6.1. 4.3% from 6.1. Now you know that headline is nothing but core plus food and fuel. Headline inflation is what? Core plus food and fuel, isn't it? So if say core inflation falls, then the impact on the entire value of headline inflation will be there, right? So this is the thing you should remember. If we talk about fuel inflation, particularly now we are talking about separate products, say fuel. Okay, so fuel inflation moved into deflation. As I told you right now that although food prices have been rising, but fuel prices have seen a deflationary trend. What is deflation? Deflation is your, what is deflation? I want your answers very quickly. What is deflation? Anyone? I told you the difference between disinflation, deflation and inflation in the very first class as well, right? Yes, what is deflation? Okay, so deflation is your opposite of inflation, right? In inflation, you have rise in overall price level. In deflation, you have fall in overall price level of, or say, yes, reduced prices. Decreasing rate of inflation? No. No, this is not the right answer. Remember, for first thing, I already told you the difference between disinflation and deflation, okay? Persistent decrease, yes, it is sustained decrease in the general price level. It is not the reduced rate of inflation. When the inflation is there with a reduced rate, it is called disinflation, remember, okay? Deflation is just fall in the prices. Are you getting my point? So fuel prices have witnessed deflationary situations. It means the prices are falling. That's why you have lesser headline inflation due to fall in core as well as fall in fuel inflation. Is that clear now? Okay. Since September 2023, with the reduction in the domestic prices of LPG, why are we able to witness deflationary situation of falling prices in the fuel related sources or products? First is that your domestic prices of LPG, very important fuel in all our domestic purposes and all other things, right? So LPG's price has eased in India, right? Your liquefied petroleum gas has witnessed a fall in prices in your domestic market. This is one reason. And kerosene, LPG and kerosene, on the back of correction in global energy prices. Now, why have we been able to do that? Because at the global level, the prices of LPG and kerosene have eased, okay? Although crude oil remains volatile, it depends on the global supply chains as supplied by our OPEC countries, right? But if we talk about LPG and kerosene particularly, so we have witnessed fall in the prices, okay? Got this point? Now tell me, what are the two broad components of LPG? Which gases are the most prominent among others? There are many more constituents of LPG, but broadly two constituents. If I ask you, what are those two constituents of LPG? Anyone? So your propane and butane, okay? Propane and butane. You should remember these things. Sometimes you can get these kind of questions, okay? So that what are the constituents of say methane, of say LPG, right? You should remember these things. So this is the thing, okay? Now, food inflation, if we talk about, yes, propane and butane, food inflation increased to 7% from 6.7%. So we have seen that food inflation has increased, but fuel inflation has eased. And in fuel, when we talk about, all products have not seen the deflation, particularly your LPG and kerosene. Are you getting my point? Right? So you should remember this. Food inflation has increased to 7%. So that's why food inflation is higher in India. Why? Reason is sustained pressure from prices of cereals. Your cereals have become costlier. Okay, pulses, spices and vegetables due to overlapping supply shocks pushed up food inflation. Supply shocks are there. So this food inflation is due to supply side and not because of demand side. So this is not demand pull inflation. This is your supply side inflation, or say bottleneck inflation, as we say, right? You all know what is bottleneck. I have told you that when inflation comes due to reduction in supply, demand remaining constant, that is known as your bottleneck inflation, supply side inflations, supply side inflationary pressure. Got this point? So in food you have products like cereals, pulses, spices have witnessed supply shocks. This might be due to climate change. As you all know that climate change is abrupting the availability of agricultural crops and products. That's how the production of agricultural crops is getting affected, and that's why you have disruption in supply chain. When supply chain gets disrupted, demand remaining constant, supply falls, your prices increase. Isn't it? So this is the thing which is happening in domestic economy. These are very important trends which you should remember. So you broadly remember that only food inflation is rising, fuel prices are easing, and that too in the case of LPG and kerosene, and the entire core inflation is falling, headline inflation is also falling. Is this clear? Okay. Now moving ahead, the monetary policy section if we talk about. So when we talk about the monetary policy of India, what has been the scenario of monetary policy in the 2023-2024? Okay, let's see. First thing, okay, let me tell you what is monetary policy first. Do you know what is monetary policy? All of you? Is there anyone who does not know? So monetary policy is basically the policy of a central bank of any country. Okay, policy of a central bank of any country. What is the aim of this policy? Aim is to maintain the inflationary level in the economy within the desirable limits. Okay, what is the desirable limit in case of India? 4 plus minus 2%. How does this policy tries to achieve this limit or to contain the inflation? It is through money supply. It is through money supply. It is by changing the money supply. What is money supply? Entire currency in circulation. Entire currency in circulation, which is to say your currency, your bank notes, coins held with the public, deposited with the banking system. So entire currency in circulation at a point of time is your money supply. Are you getting this point? By changing this money supply, central bank of a country, which is RBI in case of India, tries to contain inflation because it is the money which is there in the market leading to higher prices. Why? When you have a lot of money, in your pockets, you demand more. And when you demand more, lot of money is chasing limited goods and services. Money can be increased abruptly, but production of certain goods cannot be increased, right? So goods and services are available in limited numbers. So when a lot of money starts chasing limited goods and services, that leads to inflationary situation. So this is how, by containing money supply, monetary policy tries to contain the inflation in an economy. Did you get this point? Okay, I hope you understood what is monetary policy is. It is a very detailed concept, but I just wanted to give you an overview so that you can understand all these things happening. Okay. Now first thing, if we talk about the repo rate, so monetary policy, as I have told you, the policy of the central bank, it has broadly two kind of tools to implement these things, okay, to contain the money supply and inflation. The tools can be classified as quantitative and qualitative. Okay, broadly they can be classified as quantitative and qualitative. In quantitative tools, you have key policy rates or the key interest rates like repo rate, reverse repo, okay, bank rate, marginal standing facility. You have reserve ratios, reserve requirements, which are your CRR, cash reserve ratio, SLR, statutory liquidity ratio, and very recent new quantitative tool introduced by RBI, which is your standing deposit facility rate, SDFR. Okay, all these are quantitative tools, and there are other suggestions, guidelines which RBI gives morally to the banks, which are there in your credit rationing and all these things in your qualitative tools. Okay, so we are more concerned with the quantitative tools. So first is your repo rate. You know what is a repo rate? Anyone? Repo rate? Let me know please quickly. Anyone knows what is repo rate? Can you tell me what is repo rate? Okay, so repo rate is basically the rate at which, or you can say that the interest rate at which commercial banks can borrow from RBI for the short term. For the short term. So you should remember what is repo? Repo is rate at which RBI lends to the commercial banks for the short term. Why am I saying short term? Because you should remember this is the difference between bank rate and repo rate. Although mechanism is also different, but bank rate is the same thing through different mechanism, but the interest charged in the bank rate will be higher. Why? Because bank rate is for longer term. So RBI lends to the commercial bank via repo for the short term, via bank rate for the long term. Remember, okay. Now what is repo? Repo is your repurchase option. Repo is your repurchase option. What is the full form of repo? It is repurchase option. How does repo works? See, repo is your repurchase option. Repurchase option. This is the mechanism how commercial bank can take loan from the RBI. What is this mechanism? This is called repurchase option. So this is not the thing like we do. We go to the commercial bank, we say that we need loan, okay, they sanction your loan after some processes, okay, and then charge you with some interest rate. No, this is how it is that your commercial bank, say this is the bank, okay, bank A, this commercial bank needs loan from RBI under repo. So it has to deposit GSAC, government securities as collateral. Government securities as collateral. Now, why is this called repurchase? So what it does is that it sells these government securities to RBI. It sells government securities to the RBI. So when it sells to RBI, RBI purchases it. So RBI gives money to the bank, isn't it? Suppose these government securities are, say, worth 50,000 rupees, okay? Suppose 50,000 rupees. Just taking a very basic example so that you can understand, 50,000 rupees. So when the bank sold the government securities to the RBI, the bank got 50,000 rupees. Now there will be an agreement that the bank repurchases it from the RBI. So RBI will sell now and the bank will repurchase it. When the bank repurchases, so bank will pay this amount to the RBI. So this is how loan has been taken and then has been given back again, okay. So this is the process. That's why it is known as repurchase option. You sell it, but you have an agreement that you will repurchase it by this time, say. So that's how the loan has been given by RBI to the commercial bank. Did you understand this mechanism that under repo how loan is given to the commercial bank? Repurchase option it is called. Therefore, it is called as repurchase option. Have you understood this? Yes or no? I hope you have understood, right? So this is your repo. While on the other hand, as I told you that bank rate is for a longer term, the mechanism under bank rate is also different. It is called rediscounting of bills. Okay, I will discuss it in some other class whenever the concept arrives. Okay, so under bank rate, the process is rediscounting of bills. Under repo, the process is your repurchase option. Okay, I hope you got this concept. Okay, so moving ahead. Now, when we talk about repo rate, it has been unchanged. So presently, if you see, repo is at 6.5%. Okay, 6.5%. Why is this so much high and why the central bank has left it unchanged? Because of high inflationary pressures. You know that food inflation is there, right? Inflation in some other products is there. So due to high inflation, repo rate has been kept as unchanged. Okay, during 23-24 and continued with a stance of withdrawal of accommodation. This is known as withdrawal of accommodation. Withdrawal of accommodation. So what is this withdrawal of accommodation? Now see, you will be able to understand how repo rate affects your inflation only when you understand the application of repo in your economy. Okay. If we say that central bank or the monetary policy committee which decides all these rates, monetary policy committee has decided to keep the repo rate higher, what will be the application for your economy? So you first need to understand the application, how does it affect your economy, right? So first thing is repo is also known as your key policy rate. Okay, key policy rate. Why key policy rate? Because all other interest rates are linked to your repo. Is this clear? So in newspapers, when you read key policy rate, they are referring to your repo rate. First thing, when repo increases, for example, if repo increases, all other interest rate increase in your market. Are you getting my point? All other rates which are linked to your repo. Okay. For example, the repo rate based lending rate. So all these things increases, interest rates increases. Now let's understand it in this way that if say repo rate has increased, okay, that means the cost of borrowing cost of borrowing for bank has increased. Cost of borrowing for banks has increased. Repo rate has increased. So cost of borrowing for bank has increased, isn't it? It will be costlier for the bank now to borrow from the RBI under. Banks will borrow less. Banks will borrow less. That will reduce the availability of funds. Availability of funds with the banks gets reduced. When this gets reduced, the credit creation by bank gets reduced. Credit creation, say, okay, credit creation gets reduced. So bank give lesser loan in the economy, lesser loans in the economy, okay, loans get reduced. Also, because when repo increases, your other interest rate increase. So the rate at which bank is offering loan to the common man, there are two rates operating for that, which are your repo rate based lending rate, which are linked to your repo rate, the interest rates which are charged by the commercial bank from the customers, from the common man, from the public. So there are two rates operating for it. Repo rate based, which is linked to your repo, so directly gets affected, and the other is MCLR, which is marginal cost based lending rate. Okay, this is internal, decided generally by the banks. But the RRLR, repo rate based lending rate, which offers interest rate to the public, which is directly related to your repo, so that also increases. So loan get reduced, because when interest increases or interest rate increases, cost of borrowing increases, loan gets reduced, money supply gets reduced, and this was only the target of the RBI or the MPC. Because if there is inflation, you need to reduce money supply, you need to reduce the circulation of money in the economy, because that was the reason. And you all know, there is in economics, there is a theory called quantity theory of money. Okay, quantity theory of money. Quantity theory of money is this: MV is equals to PT. Okay, which says that your total money supply decides your price level. So price is a function of money supply. Price is a function of money supply. So if money supply increases, prices increase, as per the quantity theory of money as well. So are you getting this point? Now this is why increasing repo rate helps in reducing money supply and reducing inflation. Now have you understood why repo rates are kept high? And if there is the opposite situation, if prices are falling down and it is a deflationary situation, economy is facing lesser demand, then what RBI will do is, RBI will reduce this repo rate. So the interest rates get reduced in the economy, people get more loan, more money supply comes to the economy, and all these things get corrected. So this is how these things work. Are you getting my point? Okay, so let's come back to this analysis. So that's why repo has been changed, has not been changed, okay, remained at unchanged level. And this is called as withdrawal of accommodation. What is this? See, there is something called accommodative monetary policy, okay? Accommodative monetary policy. Accommodative monetary policy means when the RBI reduces the key policy rates and the reserve requirements to inject money supply in the economy, okay? Accommodative means when you increase money supply in the economy because prices are not so high. But when we say withdrawal of accommodation, it means tight monetary policy. You are withdrawing the accommodative stance, you are rather aiming at reducing the money supply and not increasing it. So in accommodative policy, you are trying to increase money supply, increase the supply of money in the economy. But when you say withdrawal of accommodation, it means you have withdrawn from accommodative stance, and now you are trying to increase the key policy rate and reduce the money supply in the economy. That's why this is known as withdrawal of accommodation, because it is again kept higher at 6.5%. Now I hope you have understood the entire story, isn't it? Yes or no? Please let me know. Okay. Now, to ensure that inflation progressively aligns with the target, which is 4 plus minus 2% for India, while supporting growth. Okay. So this is the repo rate condition in India. And the MPC. What is MPC? MPC is your monetary policy committee. MPC is your monetary Policy Committee. Okay, Monetary Policy Committee. Tell me quickly which all members are there in the monetary policy, or tell me the number of members first. How many members are there in the Monetary Policy Committee? Does it has members from the government side as well? Does it has members from the government as well? How many total members are there in your Monetary Policy Committee? Anyone? So it is your 6-member committee. It is basically 6-member committee. 6-member committee. Now this is your homework to find out who all are the members. How many members are there from the central bank side and how many members are there from the central government side. Okay. No, not 6 plus 1. It is 6 only. Okay, including the chairman, which is RBI governor. It is a 6-member committee. Okay. Although in a committee, it was earlier recommended, but then 6 members are there. Okay. Remember, 6 members, including the chairman, who is the RBI governor. Okay. Now, yes, central government 3 and another 3 from your central bank. Very important question which I need to address. See, we are not in any hurry. Okay. Remember, that's why we are trying to deal in detail with every concept. We are trying to understand the application. We don't want to rush up. We don't have any hurry to complete these lectures, right? Although we know that we should complete it as soon as possible, but then having done the entire report without understanding what was there in the report sounds very vague, isn't it? So let's try to understand everything which is there, the concept, the application, then only it will be a wholesome preparation for you, right? So one question which I want to ask to you, since we have talked about the MPC, is that tell me, does RBI governor has a casting vote or a veto power in Monetary Policy Committee, being chairman of the committee? This is very important question. You should remember that there is a difference between a veto power and a casting vote. This is something which we generally ignore, okay? But these kind of questions can be asked in some of these statements in your examination. Does RBI governor has veto power or the governor has a casting vote in Monetary Policy Committee? This is my question to you. So whenever you will start answering, I'll look at your answers, okay? So now moving ahead, that the MPC noted that monetary policy has to remain disinflationary. So Monetary Policy Committee has noted that we have to focus on disinflation, okay, to ensure fuller transmission and better anchoring of inflationary expectations, because inflation is higher. So we need to have this kind of monetary policy, keeping the key policy rates higher so that we can contain the inflation. Okay, casting vote, very good. So it is casting vote, not a veto power. Okay, veto power is what? When you can vote in you can vote anytime, okay, by any side. But casting vote is your extra vote will be there. Your extra vote will be there only when there is a tie. Okay, so 6 members, 3 and 3 happens. So then extra vote of RBI chairperson, of the RBI governor, who is the chairperson, will be a casting vote. So it is casted when there is a tie. It is not like a veto power that your vote can affect the decision of the committee. No. So got this point? It is a casting vote. Is used only when there is a tie. This is not a special privilege given to the governor. Remember. Okay. Now, so this is the thing that MPC, Monetary Policy Committee, decides all these rates, okay, the key policy rate, repo rate and all other situations in inflationary, deflationary situation. So they have said that we need to transmit these rate cuts or the rate, keeping the rate higher, not the rate cuts, okay, to the economy. Now there is a term called monetary transmission, which you should remember. Whether there is a rate cut, which is to say the repo rate has been reduced or it has increased, these decisions should be transmitted to the common man or via banking system they should be transmitted into the economy. Then only you will be able to see the impact at the national level. So that process is known as your monetary transmission. Have you got this? Monetary transmission. Transmission of the decisions taken by monetary policy committee to the economy via your banking system and other channels. Clear? Okay. Now, another thing is that the Reserve Bank conducted two-way operations both main and fine tuning auctions to ensure availability of adequate liquidity in the banking system. Now, we have talked about repo and all these things containing inflation, but at the same time, with regard to your banking system, you need to maintain a good level of liquidity, isn't it? To maintain liquidity, as you all know that RBI has introduced new tools addition to the existing one, which we have discussed in our editorial analysis as well. The variable repo rate or the variable rate repo and the variable reverse rate repo, VRR and VRRR, right? These are for short-term adjustments, isn't it? You all know what is VRR, VRRR, right? We have discussed them. So these tools are used for injecting and absorbing the liquidity in the banking system. So when RBI does auctions, as you know, in VRR and VRRR, okay, auctions. So when these auctions are done for a longer period, for a substantial amount of period, okay, for the impact to be there on a longer basis, it is known as main auction. Remember the difference. But when these auctions are done due to some unanticipated situations which were not anticipated by the central bank. So when these auctions are done on unanticipated basis, when due to some unanticipated situation arises, that is known as your fine tuning auction. So have you understood the difference between main and fine tuning? Main is for a longer period, okay. Fine tuning is to adjust with the unanticipated situations which have arisen, okay. And this is for temporary basis, to adjust that unanticipated crisis or situation whichever is there. Are you getting this point? So main auction, longer term, fine tuning to adjust with the unanticipated situations. Clear? Okay, understood. Then the second thing is, these concepts mentioned directly in the report are very important. You can be asked about them in exam, in interview, what is this concept, what is the application, right? That's why I'm explaining every concept which is lying in front of you. Okay. So next comes your weighted average call rate, WACR, weighted average call rate. So the report says that weighted average call rate, on an average it has traded, or it is 13 basis points above the policy repo rate. It is presently 13 basis points above the policy repo rate. Okay. Now what is this concept? Why is it higher than your key policy rate or the repo rate? You will be able to understand this only when you understand what is weighted average call rate. What is weighted average call rate? Okay. So basically, to understand this, you need to understand money market. Okay. You need to understand that in money market, see, two things are there. First is, we take loan from the commercial banks. Okay. Second is, banks take loan from the RBI or the central bank. But there is third thing also which is happening, that bank lend among themselves. Lend among themselves. Okay. For example, SBI, ICICI. Okay. For example, SBI needs money, so ICICI gives money to SBI as a loan. So there are interbank transactions as well which are happening. Are you getting this point? Interbank transactions. So banks also lend to each other, which are known as your interbank transaction. And when we study about interbank transactions, there are three terms which are important for you. First is call money. Second is notice money, and third is your term money. Okay, so call money is when your transactions are for say 1 day, 24 hours. Okay, overnight transaction, overnight giving and taking of loans by the banks among themselves, among the commercial banks, for example, right? So for 1 day you have call money. When the transactions time period is more than 1 day but till 14 days, say 2 to 14 days, it is notice money. And when it is say 15 days and beyond, it is your term money. Okay, so you should remember call money is your interbank transactions which happen for 1 day. Understood this? Now you will be able to understand what is this weighted average call rate. So it is the interest rate, average call rate, call money rate. Call rate is your call money rate. Call money is what I told you, the 24-hour transaction, interbank transaction for 1 day. Okay, so the interest rate at which banks are transacting with each other, interbank transactions are happening, is your, for call money for 1 day, will be your call rate. Have you understood this? Please let me know, yes or no, right? So call money rate, the interest rate charged for call money, that is interbank transaction for 1 day. Got this point? Yes? Alright. So this is your average call rate or weighted average call rate. It is basically average of your call money, interest charged on your call money. Okay. Now it is given in the report that it has traded higher than the repo rate. So if you see the present call money rate, it will be higher than your repo rate. Why is it higher? Now is this question. You should try to understand the picture going on, why this is happening. Because you know, repo is at 6.5. It has been kept unchanged due to higher inflationary pressures in India. You have high inflation, so you need to contain some liquidity, at least with the banks. You have to maintain the adequate amount of liquidity, but then you have to contain it at least to certain levels. Otherwise, the liquidity from bank will flow towards the public. Isn't it? So this rate is higher than the repo so as to maintain or contain the liquidity. So it is in accordance with your withdrawal of accommodation stance of the Central Bank of India, which is your RBI. So it is in accordance with your withdrawal of accommodation that this call money rate is also higher. Clear? So I hope all these situations are clear to you. Why are they happening? What are the concepts, right? So this is what the report talks about in terms of India's monetary policy. Okay? Now we have to look at the financial market as well. Financial market. If we look at the financial market condition of India, you all know that we have discussed in our previous editorial classes, there were 3-4 times, there were articles on FII, FPI, FDI. So we have discussed that Indian financial market is performing really very well. Isn't it? Indian financial market is exuberant. I am not talking about the market yesterday or today. Okay. I am talking before elections. Right? So Indian financial market is performing very well. There are certain reasons behind it. We have discussed some of them in our not some of them, rather all of them in editorial analysis as well. But let's discuss them again. So what is the situation of financial market? First thing, the report is saying stability. Stability in what? Stability in your bond and forex markets. Bond market, forex market have been stable, but your equity market, your share market is exuberant. It is rising. Okay. So your share market, your equity market is exuberant. It is rising. First thing. Okay. Second thing is Second thing is GSEC yields. The yield or the earning, your earning on the government securities have softened, eased. Okay. So GSEC yields have eased on favorable inflation prints. First thing to understand this entire sentence, you need to understand how the government securities, or particularly if we talk about bond market works. So I hope you all know, as I have told you in one of the editorial, well, that in bond market you have an inverse relation between price of the bond and the yield or the interest which you earn. Are you getting this point? Do you remember that there is an inverse relation between them? Okay. I am not going too much into the technicalities, but I just want you to understand that this is how bond market works. It is not like the share market. In bond market, since the interest is your fixed, for the annual rate is fixed, okay, and you have a face value of the bond, the relation between your bond price or the face value and the yield is inverse. Do you know this? Right? For example, if suppose the bond which you purchased for 100 rupees, which you have purchased for 100 rupees, this is your face value. The coupon rate or the interest rate, which is annual coupon rate, say is 10%. Okay. So you will get 10 rupees, okay, on this bond. Now suppose due to much demand, okay, due to much demand of this particular bond, this can happen due to any reason, the prices increase, bond prices increase, okay, prices can increase because when demand rises, price increases. So what is the price? Fixed face value but no ownership, yes. What happens is when prices increase, so now say 200 rupees, so now the bond market, the new bonds which are being issued are say for 200 rupees, okay, you are holding 100 rupee bond, but the price has increased, say 200 rupee. So given this price, your yield should have been again 10%. If the coupon rate is going on as 10%, how much should have been your earning from this? Tell me quickly. I want your responses very quickly. How much should you have been earning given this increase in 200 by 100 rupees, which is now 200 as the face value, but the interest rate or coupon rate is same, 10%. Tell me, what should have been your earnings? 10 rupees? No. This is your actual earning. I am asking what should have been your earning given this change. Yes, anyone please. Quickly. 20 obviously, right? Okay, but now how much you are earning? 10 rupees only, isn't it? Because this is fixed. Are you getting my point? So it is a loss, okay, or not even a loss, but say try to understand that this is an inverse relation happening. Prices has increased, but your yield has fallen down as compared to the level which it should have been. Are you getting this point? Yes or no? Just very simply, I have tried to make you understand, although there are technicalities over there, but we will not go into those technicalities, okay? Just let me know quickly you have understood. This is how bond market works. So when prices increase, yield falls, okay? But that is not a bad situation. That is not a bad situation. Yes, yield is calculated based on face value, coupon rate divided by face value. I know that. That's why I told you we are not going into technicalities, just trying to make you understand very superficially, okay? Otherwise, I'll need entire 2-3 hour class to explain the entire bond market to you, okay? Right? So just trying to give you an overview so that you can understand this is what happening, okay? So this is how there is an inverse relation, okay? Now when we say that government security yields have softened, so they have reduced, that means price has increased. Yes or no? Yes. So if we say yields have softened, that means prices have increased. When does price of government bond will increase? when people are having more confidence into the government securities market, or when there is more demand of these bonds or these securities, right? So if yields have fallen down, that means prices have increased. Now why is this happening? This is a good indicator. Okay, this is a good indicator as compared to rise in yields, because if yields have been rising, that shows falling prices. Falling prices is not a good sign for your economy, for government securities market. Are you able to understand this? So if prices are increasing, that means people are demanding government securities, and prices are increasing, that's why yields are falling. As you know, that this is how bond market works, right? So why is this happening? Why we have a good government securities market on? Because this is due to favorable inflation prints. The RBI is trying to contain the inflation. Core inflation is falling, headline inflation is falling, so inflation is somewhat favorable for the economy. Yes, yes. Okay. Now reports of inclusion of Indian bonds. This is something which I have discussed with you in, I think, one of the editorials. We have seen that Indian bonds are to be listed by JP Morgan. Okay, by JP Morgan, if you remember, by JP Morgan. If you remember, we have discussed this news, right? So listing of Indian government bonds has boosted up this market. This is a good sign. So our markets are being exuberant, are becoming strong. Are you getting this point? Yes? Okay. So this is one of the reasons. Listing of Indian bonds. JP Morgan has announced, we have discussed in editorial class as well, in major global bond indices, and lower than expected market borrowings by union government. This is another reason why people are showing confidence into government securities. Investors are showing more confidence into government securities. Government has borrowed lower than expected, not than the higher than the expected. Okay, lower than what is expected from the government in the as expected in the interim budget presented for 24-25. Are you getting this point? So when government is borrowing less, that will reduce your crowding out effect which happens, isn't it? You know what is crowding out effect? That when government borrows more from the market, lesser funds are available for the private borrowers or investors. Moreover, one more reason we have discussed, that RBI has decided to transfer 2.1, but return is on face value at the time. Yes, so all of you, please do not indulge in this debate. Just remember that this is an inverse relation, but in case of bond market, when price increase, yield falls, and when price falls, yield increases. Got this point? We can discuss these entire mechanism in some other class, okay? But now we need to complete this thing, so that's why not indulging in the exact calculation. Just try to understand this. You can go and study about the bond market, okay? Yes. $1 billion or $1 trillion? Shreya. So as you know that we have discussed that there is a huge surplus transferred by RBI to the government of India. That has also boosted investors' confidence that now government has funds to manage everything. Are you able to get this, right? So all these factors combined together, lesser government borrowings, huge RBI surplus transferred to the government of India, and inflation easing in India, all these things have contributed to government securities market performing good. Are you getting my point? Okay. Now, then corporate bond yields have also moderated, tracking this trend in the government securities. Okay. So, corporate bond market has also performed well. Are you getting this point? Okay. Tracking the GSEC yields, and corporate bond issuances have increased. Now, see,
softening of the yield is a win-win situation. Why? Since government also has to give you lesser interest rate. So prices increasing, coupon falling. Are you getting this point? Yes or no? Right? Government also has to pay you less interest rate and prices have increased. You will also be able to gain out of it. Isn't it? So it is a win-win situation for both. Try to understand this. So on government's part, the fiscal consolidation will be maintained as well. And then issuances of these bonds will be increased because you have to pay less interest now because this is a bond market. If price increases, your coupon falls or yield falls. Got this point? So corporate bond yields have also moderated from the higher levels, and GSEC yields have also moderated. This is the thing which is there in Indian financial market going on. So let me know, have you understood all these things which I told you in case of financial markets and the earlier sections which we have discussed? Yes or no? Very quickly. Yes, ma'am. Trillion, yes. Yes, so it is not billion, it is trillion, okay? Yeah, I understand that, there are certain human limitations. You do not, sometimes you are not able to remember the figures. Need not worry about that. I just try to correct you so that you don't remember the wrong data, okay? So I hope you understood all these things, and since there is a time constraint, I try to explain every concept to you which is there, but in accordance with the required time limit and required concept, okay? I cannot go in expressing or explaining the entire detail of a topic because you have to understand that we have time limit, okay? So I hope this is useful for you. This was useful for you. Keep on revising these trends, these classes. They are a whole package for you, right? Entire static being covered, analysis, application part being covered. So it is your interview level preparation. Mind this, okay? Mark my words, this will help you in your interview level. So we will stop here for today's class since we have class at 12, our editorial analysis as well. So I have to prepare that as well. And that was it for today. I'll take up from here the Indian rupee stability in your next class will be which will be day after tomorrow. Okay. So I'll take up from here. Keep on revising. Thank you so much for staying focused, staying tuned. Have a very great day. I'll see you in the editorial class at 12. Okay. Yes, another reason can be this as well. Okay. All right. Thank you so much. See you in the next session.